Hey traders, welcome to video 14 of the Forex Beginners course. This is Corey Mitchell. In this video we are looking at creating a trading plan, brought to you by Investu.com. Trading requires a plan. If you try to wing it, you are going to fail. Without a plan, you don't know what works and what doesn't. You need to do the same thing all the time to know if it works or not. So if you step into your trading environment, you open your platform, you look at a few charts and you just decide, yeah, I'm going to go long this one, I'm going to go short this one, and there's no real plan there. You have no concept later on of what works and what doesn't. You may, even when that trade ends, you may look at that trade and thought, what was I doing? Why did I take that trade? With a plan, you at least know why you took that trade, how you're going to manage it, how you're going to get out. That way, when you look back on your trades, you can see how you can improve. If you don't follow that plan, you have no idea why you took those trades, why you got out of them, how you manage them. So it becomes very hard to improve as a trader when you're just sort of winging it. Until you have a plan and you follow it, you're not going to know how to improve. So trading with a plan also relieves a lot of stress. It takes a lot of the emotion out of trading. If you, as I said before, if you just open your platform and start making trades, it can be extremely stressful because you have no concept of how to manage those positions. Whereas if you've set out a plan, you say, I'm entering here, I've set a target here, and I've set a stop here, and now I just have to let it hit that stop or target. Let's say that's your strategy. That's it. You have nothing else to worry about. You may want to watch it, but you can also just turn your computer off and walk away. That trade's technically done. Your work's done. The price is either going to hit your target or it's going to hit your stop. That is a planned out trade. When that plan isn't in place, it becomes much more stressful. So a trading plan consists of 4 primary sections. The first one we'll simply call restrictions, or just some general guidelines for what you're actually going to be doing. So this covers which market you're going to trade, so Forex, or if you're going to trade another market as well, so this may cover Forex and futures, let's say, if you're going to trade futures as well. But for the sake of this, let's just say that you're trading Forex, so it covers the Forex market and what pairs you are going to trade and when. So you want to create some guidelines for yourself. Maybe there's some pairs that you need to avoid simply because you don't know much about them. So let's say the US dollar and the South African dollar, or the Danish, or the any other currency pair that you don't know a ton about, maybe the Chinese currency. So you just don't know a lot about them, so you've decided I'm going to restrict those, I'm not going to trade them. I can trade all the common pairs that we discussed near the start of this video series: the US dollar, the Australian dollar, the British pound US dollar. So write down the pairs that you're going to trade and the ones that you have to avoid. This creates a guideline for you, so that, let's say you do happen to hear somebody mention, oh, the Chinese currency is flying off the chart, and you decide, okay, I'm going to step in and do that. But you don't really know anything about that currency, so avoid trading it. Follow your trading plan, listen to it. Restrict currencies that you don't want to trade, either because of spread or something like that, and just stick to the ones that you know. There's lots of opportunities in pairs that are actively traded and that you know something about. Are you going to day trade? Are you going to swing trade? Are you going to do both? Are you going to be a position trader where you're taking positions for potentially weeks or months? So define how you're going to trade. You don't want to be jumping back and forth. I do both. I like to day trade and I like to swing trade. So I will take swing trade positions and day trade positions in different pairs. You're also going to want to define here, if you have a day trade out, say in the Euro USD, can you take a swing trade in that same pair? So there's no hard and fast rules here, it's just what you decide. You have to define these things for yourself. How are you going to classify yourself as a trader, and what rules are you going to set for yourself? So the next major section of our plan is the entry rules. So what criteria is required to enter a trade? What is your trade trigger going to be? So what has to materialize for you to actually take a position. So you want to go long the Euro USD. What conditions are present for that to occur? The trade trigger is what actually triggers the trade. You may say, yes, I want to get long in the Euro USD, but what is actually going to trigger the action? You need to have something that initiates the trade. So whether it's the price hitting a new high or an indicator crossing over another indicator, something like that, you need something that tells you to get in. You want to be very specific with your entry rules. For example, you may say, I'm only going to trade with the trend, but how do you define the trend? You need to be very specific, because looking at a 5-minute chart, the trend may look all of a sudden very different than on a 15-minute chart or an hourly chart. So how are you going to define that trend? Be very specific. Why are you going to enter, and how are you going to enter? If there's any ambiguity about whether you should or shouldn't be taking a trade, your plan isn't specific enough. So if you see a potential trade and then you start second guessing yourself, the trade, you haven't defined it well enough in your plan. You want to go back and make sure that there's no real ambiguity there, so that when the time comes to pull the trigger, you are going to pull the trigger on that trade. You're also going to want to have exit rules. So you've got into a position, but how are you going to get out of it? We have two options. We have the stop loss, and we have which controls losing trades, and then we also have to get out of our winners. We can't just let our winners run infinitely, because they will eventually turn back into losses. What criteria is required to exit a trade? Are you going to use a stop loss order? Are you going to use a trailing stop loss order? Or are you just going to manually exit the position? If you're going to manually exit the position, how are you going to do that, and why are you going to do that? So it is true, the price, let's say the price is running in your favor, there's an uptrend, all of a sudden you notice a lower low, a lower high, so that potentially indicates that that uptrend is in trouble and a downtrend is beginning. That would be a point where you could look for a manual exit. The reason you're in the trade is the uptrend, but since that's no longer there, you want to get out. But how are you going to get out of that position? What is your trigger for getting out? Profit targets as well. In a winning trade, are you going to use a profit target to establish when you get out? Profit targets make it easy. If you have a stop loss and a profit target, you can just wait for the price to hit one of those and you're set. That's all you have to do. You can also implement a trailing stop, so you just keep moving the stop up as the price moves up, and that will lock in some profit as the price moves in your favor, and eventually it'll stop out the position when the price pulls back far enough. You can also look to manually exit. Again, we discussed that before, but you want to know why you're going to do that manual exit and how you're going to do that manual exit. Again, be specific. If you say in your rules, I'm going to place a stop behind a major high or low, how do you define major? Is that major on your time frame if you're trading on a 1-minute chart? Is that major on an hourly chart? How do you define major? Again, if there's ambiguity about where you should be placing a stop or how you will exit a position, your plan isn't specific enough. As you start trading, so we're going to go through what your process is. So you create this plan, then you start going into a demo account and trading. What you're going to find is that there is going to be some ambiguity in your plan, and you're going to have to keep sort of revisiting it and filling in some blanks that you may not have thought of before. And the more experience you get, the more you're going to be able to fill in those holes in your plan, so that eventually becomes a very good, solid plan. So money management is the fourth section of our plan, and one of the main things that we want to focus on here is the maximum risk. So you want to define your maximum risk. So I've said before, mine is 1%. I don't risk more than 1% of my account on a trade. 2% absolute maximum if you have a very small account and you're just starting out. Ideally, you want to be risking less than 1% of your account, but 2% is the absolute maximum. You also want to establish a maximum risk for all positions. So if you're risking 1% on a trade, can you take 100 trades? That means technically, while it's unlikely that all those would lose, if they did, you've lost all your capital. So is there a maximum risk on all your positions? So maybe you want to cap your trades at 15 or something like that. So that would mean that if you're risking 1%, 15% of your capital is technically at risk at any time if you have a maximum of 15 positions out. You also want to look at, can you trade correlated positions? So we looked at correlations and volatility in a prior video. If the Euro USD and the British Pound USD are highly correlated and moving together, can you have a long position in both? There's no right or wrong, it's just, can you do it? As we discussed in that video, even if they're highly correlated, they're going to have slightly different tendencies. So it is okay to take positions in both. I do take positions in correlated pairs. Simply I'm normally risking less than 1% on my account on each trade. So if I have a couple correlated positions, my risk is still pretty small, even if those positions do tend to move together. So if I lose on one, I'll probably lose on both, but that's okay because my risk is small. I'm okay with that. So it'll be up to you to decide, can you take correlated positions? And if so, how many can you take? If you take 1 or 2 highly correlated positions, that might be okay, but can you take 10 correlated positions? That would be something you'd have to consider for yourself. I would probably recommend not. I'd probably cap it at about 5. That way, 5% of your account, that's still quite a bit, but since they move a bit differently, you may be able to manage that. So this is something you'll have to decide for yourself if you're going to do this or not, or if you decide not to, if you have a potential trade in the British Pound USD and the potential trade in the Euro USD, you're just going to have to decide which one you want to take and take one of them. So the more work you put into your trading plan, the less stressful trading is going to be. Test out your plan for profitability in a demo account and don't trade live until you are profitable. If you aren't profitable in a demo account, there's no reason to think that you'd be profitable in live trading. Live trading is even more difficult. There's more of a psychological demand on you because it's real money. So if you can't make money in a demo account, do not make the switch to live trading. Whether it's in a demo account or live, once you're profitable, make sure you have tested out for at least a month. Even if you lose money in the demo account, it will develop your discipline in sticking to the plan. So a lot of traders they'll create a plan, go to the demo account, they lose money on their first day, and they decide that plan's crap, and they check it out. Start a new one, go into a demo account, try it. It works for a day or two, then it loses money, then they get rid of it, create a new plan. And this is the cycle. They're always looking for something new. You develop no discipline that way, and you're actually developing a very bad habit. So instead, even if you're losing money, once you've created that plan, stick to it for a month, because this is going to build your discipline. You're going to force yourself to follow that plan. The plan, or the goal as a new trader, is to simply follow your plan. If you follow that plan, eventually the money's going to come because you're going to work out what's wrong with that plan. And when you do, you're going to have the discipline to start following it and make money off the good plan. So if it's unprofitable after a month, revisit the plan and try to improve it. Then again, you're going to try it out in the demo account for a month again, and this process continues until you have a profitable system. So once you've made a profit for the month, you have a good system, you can still look to refine it a little bit, go back in the demo, maybe your results will improve. But until you're profitable for a couple months in a demo account, don't switch to live trading. Once you are profitable for a couple months, then make the switch to live trading. Do exactly what you were doing before, continue to follow your plan exactly, and keep risk below 1% per trade. So that's how you build your trading plan. Make sure it's thorough. You're going to create it, step into the demo account, try it out, stick to it for at least a month, make any refinements, go back, trade it for another month. This is how you become a successful, disciplined trader, because you're going to find out what works and what doesn't. Until next time, happy trading.